It's nice seeing you. You know, over the last at least month and a half, I've still been very negative on the markets and the economy, and that has actually played out in trying to be very risk adverse as we've kind of gone into the summertime. And you know, many of you are wondering why I have been so negative, especially with what is seemingly good news that keeps coming out almost daily with respect to the coronavirus and some good trial runs for drugs. We have decent news coming out with the reopening of the economy, things like that. Well, I've just got done talking with an insurance, basically an insurance agency, talking with some people that I know working with personal insurance, so houses, commercial real estate, things like that. And there's still a lot of issues and pain out there. And when we were talking about the business in general, they're going to be off about 20% or more. And that's on the good side for this year. And they're very excited about that they're only off about 20%. But what that means is that there's a lot of businesses that are going to be hurting significantly, and we're going to have a very high unemployment rate that's going to be here for an extended period of time. Now, what's been going on is that we've had the Federal Reserve really injecting a lot of liquidity into the markets, and that's actually propped us up. And it's been so interesting to see that really every single time that we've started to go down in the markets, they've been right there to prop things up. And that is obviously helpful. But what that also is trying to signify to me is that we wouldn't be here without their intervention. And so right now the markets are very dependent on the Fed to be levitated in this manner that we are at. And that's not necessarily a good thing. So when we have the reopening, when we have obviously coronavirus risk that's out there still of a resurgence of the virus that we're seeing now in China and Beijing area, but then coupled with not only the forbearance of mortgages that are starting to roll off the books here at the end of the summer, we already have credit cards, we have cars that are now, those forbearances are coming due, so people have to start paying on those again. And then we also have many other things like obviously the election that we've all forgotten about right now, but that's obviously going to be a big deal. And each one of those have implications for the summer and for uncertainty. And so kind of expectation is that we really can't go much higher without federal intervention with the stock market and propping up the bond market as well. And we can't go much higher without a sustained increase in the economy. And if both those things happen, we're going to be in a great place with the economy, with the stock market. But right now, there's a very big disconnect from the data, from the things that we're seeing, and what's going on. So that is why I've still been very negative. And the summer is going to be very telling, especially July, when companies have to start reporting their earnings. So we're going to have basically a big kind of run, probably the end of the quarter for the stocks. But then from there, it's going to be really about trying to figure out, will this be sustainable in the economy, or is there going to be a huge resurgence of layoffs that are happening, and obviously whether the coronavirus comes back or not. So that is something to be considering. That's why we're still very low risk right now, and on every pullback we'll be starting to add more and more into the markets, and good opportunities come. So with that, take care.